Okay, so thank you everyone for joining the webinar today. We're going to be covering the Q3 2023 GTA commercial real estate market. I'm going to give you an update on what were the activities we're seeing in the market today and give you some little insights about how you can approach things in the markets going forward. What we will cover first off is we'll take a look at the retail market and the activity, the sales volume, the transactions, and what we've been seeing over the last 90 days. We'll then go into the industrial market and cover what I'm seeing there as well. I will also share with you some insight as to where I'm starting to see some distress or where the potentials can be in the market for some distressed properties and distressed sales as of year to date. And then ultimately, I'll share with you kind of the biggest risk I see to the market, but also the biggest opportunity that can be taken advantage of for what I see coming down the pipeline. So to start with the retail market, and I'll just open this up here. Overall, retail sales volume, and I'm taking a look at properties over 10,000 square feet. We saw a 64% decrease on a year-over-year sales volume. So if you look at the chart, we've been gradually decreasing really since 2021. If we estimate that, 2022 was the peak of this market, we've just seen a gradual decline in the amount of sales volume, but also in the amount of transactions that are occurring. So retail sale transactions diminished about 35% from a year ago. That's down to about roughly 17 transactions we saw, or 11 transactions we saw this quarter or this past quarter in comparison to 17 of which we saw last year. And then to give you an idea, the sales volume is down to about 131 million. If we take a look at on the 5-year chart where where the trends have been, this is really even lower than what we saw in the pandemic, even pre 2019. So sales volume is decreasing overall. And what I'll share with it, and this is similar with the industrial asset as well, is that it's not necessarily that there's a lot of listings that are staying on the market that no one's interested in. There's still a lot of buyer interest in it. It's just that we're seeing less and less listings available, which then reflect in lower sales or lower transactions as we go forward. If we take a look over on the quarter-over-quarter numbers, we see a little bit of a discrepancy in the fact that there's a 160% increase from Q2 of this year. Q2 sales were historically low at roughly around $50 million in sales. So really anything above that, you're going to see a greater increase on a percentage basis. But overall, if we look at the last five quarters or the trend that we've been noticing, it's been continually down. Q1 2023 of the start of this year, we saw a big spike just because of a lot of transactions that were consummated in Q3 of 2022 or Q4 ended up closing then. Just to give you an idea, it takes roughly about 90 to probably 180 days for us from start to finish on a sales transactions. So you can assume that any deals that were completed in Q3 of this year were started in Q1. Maybe they went under contract or their conditional period expired during that time. On a transaction number volume wise, again, we saw a 57% increase in the number of sales, but we're still an extremely low number in comparison to other quarters, and the trend line has been going down negative. So like I mentioned, it's the amount of listings that are available for sale. There are still buyers, and there's still a big gap between sellers' expectations and what buyers can pay in this new interest rate environment. And as a result of that, buyers are underwriting deals a lot more stringently, as well as their banks or their financial institution, their lenders are being a lot more difficult in forwarding them financing. So as a result, we're seeing slower amount of sales, but that doesn't necessarily mean there's less interest for that particular asset class. If we take a look at the industrial market overall has been quite stable. It's been kind of the darling of all the asset classes over the last several years. It's continued to see strong price growth and strength within the rents as well as on the per square foot sales numbers. And what we saw is a slight uptick of about 4% in terms of the sales volume from last year, which last year was the peak numbers in terms of sales. This year we saw $566 million worth of sales in this quarter alone. We did see a decrease in the number of transactions, but just only slightly at around 19%. I think we saw a total of 44 deals completed, where previously last year we saw 54 deals. So what that is telling me is that what we're finding is that the average sales price is increasing per deal, but we're seeing less the number of transactions that are occurring. And again, for this specifically, this is a lot of user-driven activity, but the reasoning is what we're finding is that, again, if there's anything available on the market that comes available for sale, it gets gobbled up quite quickly. So there's not like there's a ton of listings sitting on the market waiting. Industrial seems to be having some consistent turnover. If we look at the quarter-over-quarter numbers, we're seeing that the sales volume has decreased 35% from Q2 last year, or Q2, sorry, of this year. And that just, again, that's just a reflection of the amount of listings that were available at that particular time, which showed that there was a large amount of sales in comparison to this quarter. We're roughly in line with what we saw in Q1 of earlier this year. So that's why you see this choppy graph. As there's more listings, more sales. As there's listings that get gobbled up, then there's less transactions there to record. And then on the transaction numbers, the same similar thing. We were down slightly, but I continue to see those numbers increase. Now the question then becomes, okay, how does this overall relate to the overall market in the GTA? If we take a look back historically, this is a 10-year chart of all GTA transaction sales of all asset classes. We saw a peak in 2021 of $35 billion worth of sales that was completed in 2021, which seemed to be a lot of the peak. 2022, we saw $30 billion in sales. Right now, and this is where the asset classes, you'll get a distortion with it. Industrial is the one that seems to still be rocking away, but all other asset classes is seeing a significant slowdown in the amount of deal transactions, and that's what's bringing down the entire market numbers. Based on my estimates on what we've been selling over the last 3 quarters, we're estimated to probably end the year at around $14 billion worth of sales. If that ends up being true and we don't have a big fourth quarter this year, that would put us back to 10 years trend line, where in 2013, 2014, where we were only seeing about $14 billion worth of sales. So it's a 50%, it's over a 50% drop in the amount of sales volume. And that's specifically attributed a large number to the interest rates and just the ability for buyers to purchase and to close on assets. It's becoming increasingly difficult in order to do so, as some lenders are pulling back on a lot of financing, and it's making it challenging. Now, to give you context to overall, and just to share that it's not just a GTA or Canada problem, in New York City, they're estimated to only do about $10 billion worth of sales this year. To give you an idea, on average in New York City, they sell about $30 billion worth of transactions a year on that's the 5-year average number. And to do 10 billion is completely, it's completely decimated their market. So what this goes to show, it's a global issue, and it's a global issue of this increasing financing restrictions, that what we're finding, or the rising of interest rates overall, and that's just really affecting commercial real estate specifically, who's quite financing sensitive. So what I chose to look at, and what I found that was interesting with this market is, well, how is financing distorting this market, and how can I represent that in the data to show, okay, well, what type of asset classes are best positioned, or is it a price point issue? So what I decided to look at was, I took the sales for this year and last year of the number of sales below 10 million for both retail and industrial. And then I also took on a separate chart, and I'll show you after, sales above 10 million, and we can see the bifurcation of it, of the market through the statistics. So to give you an idea here, retail sales saw about 383 sales last year of retail transactions. This is all retail deals below $10 million. Right now, we're at 242 sales currently, and we're on pace to probably do about 322 sales. So that would have a decrease of roughly 18%. In comparison to industrial, last year there was 224 sales that were completed below 10 million. And right now, year to date, we're at 118. So we can anticipate that roughly we're on pace to do about 157 deals, or roughly about 30% decrease in the number of transactions below 30 million. Now, the numbers change when you take a look at sales above 10 million, and we can see a complete drop off. So as we take a look at retail, there was 42 deals last year completed above 10 million. Right now, we're on pace to only do about 26. There's 20 deals, I believe, at this point for retails over that. So that's a 38% decrease. What that goes to tell me is that financing, it plays a huge part in getting deals and transactions done above the 10 million mark. What we find is anything sub 10 million or even sub 5 million, that snap bracket is good enough where buyers can put up a lot of equity or have a larger down payments, and they're able to circumvent a lot of the financing requirements, or even in the short term can pay a lot more cash, which allows them to be less sensitive to the financing or interest rate environment, as opposed to over 10 million, where even if you have 5-10 million bucks and the sale is 20-30 million dollars, we see a complete decimation of all those transaction levels. So what that means for sellers is that if your asset is priced in that snap bracket price range, chances are you're still going to see the activity, you're going to still generate a lot of interest. But if you're over the 10 million mark, look to offer financing options, whether it's vendor takebacks or flexibility in terms of allowing buyers to complete transactions, just because there's such a larger capital requirement. The difference with the industrial market is what I find is that the industrial sales are slightly different, or don't represent a lot of the number, for a couple of reasons. Number one, for the industrial market, the way the pricing that we've seen is that it's largely user driven. So they are less price sensitive to interest rates as an investor would look at a particular deal. And as a result of that, the building sizes that they require as they expand and grow, and also with the price per square foot, has put a lot of the average numbers really above 10 million. And that's why we see a larger number in that sense. I think there's 145 deals last year over 10 million. And this year, I think there's going to be about on pace to do 162. So gives you, even though it's slightly decreased, you can get an idea that that the industrial market just operates a little bit differently. I think the numbers for industrial will change. Even if I did over 20 million, over 30 million, then we'd see a complete drop off in the amount of transaction numbers. But it tends to be, 10 to 20 million dollars seems to be a lot of majority of the transactions, and that's what is playing a factor. So that's kind of my justification for how financing is affecting and really distorting the market in terms of the amount of sales going forward. So the next question on everybody's mind is, okay, well, where's the distress in the market? Where are we seeing it, and where can we anticipate some of that going forward? And unfortunately, right now, year to date, we don't see much of it. For retail assets, year to date, there's only 6 transactions that were either sold on a court-ordered receivership sale or under power of sale. So that's how I've categorized distress, compared to only 2 that was last year. So yes, there's an increase, but in comparison to the overall market in terms of the amount of sales it's a very negligible amount. Maybe it's less than 1%. Industrial, we only have about 4 transactions year to date. Last year there was 2, so even though if there's a 50% increase, it's still only 4 deals. Where we are seeing it really big is within the residential land or commercial land, where financing is playing a huge factor. As leverage is really important to push through the development process, and that's why we're seeing a lot of deals and transactions occur in that area. So I think right now, year to date, there's about 13 that have gone to receivership in comparison to 12 last year, and we anticipate more that's going to increase down the line. Year to date overall, we're really only seeing 23 transactions over all asset classes. Hotels haven't seen anything as yet, in comparison to 16 last year. So we've already exceeded last year, but still negligible in terms of the amount in comparison to the overall market. So this leads me into, Cole, where is the biggest risk, and then where's the opportunity in this market? And how I thought about this was, how could I represent where is the biggest challenge that could face property owners and provide the best opportunities for buyers in this market? And I think it deals with a lot of the interest rate and renewals that are coming due. So what I chose to take a look at, and what this pie chart shows, is that sales of or properties that were purchased, retail or industrial, in the last 3 years, so in 2020, 2021, and 2022, I took a look all the interest rates that were sub 4% and below, and characterize how many of them are up for renewal in 2024. So right now, what we're looking at, there's about 163 deals that are up, or properties that are up for refinancing in 2024. Vast majority are in the retail asset class. And what a lot of these buyers are going to run into is that if you're unaware of what the mortgage rates are for commercial right now, you're looking anywhere from as low as 7 to about 9%. 8% average in terms of your interest costs. If you have just purchased a property in 2021, 2022, you have a high loan to value, there's a good chance that with these new interest rates essentially doubling on you, it's going to be difficult for the debts to qualify at those debt service ratios. And you're going to run into a situation where the lender is going to require you to pay down that loan, or what's called cash in refinance, meaning put in more equity to pay down the debt so that you fall in line with those DSR or those requirements. Typically for commercial, it's 1.3%. They're looking for above the mortgage in terms of the qualifying. So a lot of owners are either going to be forced to put cash in if they can't, if they do not have any cash, or they don't have the ability to raise capital from their partners or investors. Then we may see a lot of properties on the market for sale in terms of being able to liquidate it just because they can't. And the unfortunate reality with a lot of the asset classes, or these two specifically, I'll share that I probably think there's probably going to be more opportunity within the retail segment as opposed to the industrial for really one reason, in terms of the rental rates increases. Not only is there less industrial properties, but rental rates for industrial has increased so dramatically really over the last 5 years that I think the increases in the rental rates, if they're up to market numbers, should offset the interest costs that you would be bearing on it. Now, you'd have to run your calculations on each asset and in the different situations, but I'm anticipating that rental increase should offset any interest payments that you have, or you'd have to pay down the loan slightly a bit if that's the scenario, as opposed to retail, where even though many our occupancy levels are at quite high, 98, 99% in a lot of the assets, the rental rates haven't increased to that level. And as a result, even though you are 100% occupied, the cash flow from the net income doesn't support the new debt levels at 8%. And there's going to have to be an adjustment of that. So I can see a lot of stress coming down the pipeline with that. We just had a presentation from RBC sharing with us that, look, this is what they're looking at as the biggest risk over the next 18 to 24 months, which I believe we're probably in a higher than normal interest rate environment for longer. Even if they were to decrease interest rates, we're probably going to stay within somewhat of this range, meaning that many buyers over the next 2 years are going to be refinancing into the environment. What I have been working with some clients on and discussing with commercial brokers as well as other lenders is options that sellers can do if you face this particular situation. What I encourage is, obviously, if you know you're coming up for renewal, get ahead of it beforehand. But what we're finding is there's options where you can structure interest-only payments or interest-only financing for maybe 2 years or so, with the hopes that we can refinance into a better interest rate environment once things calm down over the next 2 years or so, and allow us to kind of A, reposition the asset if we need to release up space or increase rents, or B, look to sell it at that point and liquidate it, but not be forced to do anything because of the new interest rates that may come down the pipeline next year. So that's what I'm tracking going forward, and I will keep you in the loop on how this performs out. I mean, even out of the 113 that end up selling or that are coming up for refinance, even if 10% are all of a sudden available on the market, that's that much increase in the amount of supply that could be available. So there could be a lot of deals. Anecdotally, what I'm seeing is properties outside the GTA. I'm talking Kitchener, Waterloo, smaller markets in southwestern Ontario or North and Barrie. We're starting to see some of the quality assets come available for sale as the outer markets start to feel a little bit stressed. What we're finding within the GTA itself is that things still seem to be quite stable, even though I am seeing cap rates starting to increase more substantially outside the GTA, but they are starting to increase, and buyers are getting increasingly more stringent on their underwriting of deals because they can't pay for it. They can't pay the 4 caps for stuff when their interest rates are at 8. So that kind of gives you an idea of what I'm seeing in the market going forward, and depending on your situation, how you can position yourself going forward. Obviously, just wanted to share high levels with you. If there's anything specific that you have regarding your property or any particular questions, reach out to me. I'm working with clients all the time on these issues right now as things are ever changing, and looking to be a resource and a helping hand to navigate this this current market that we're in. So just wanted to share this at the end of the presentation, and if there's any other further questions, I look forward to hearing from you and keeping you in the loop on more things going forward. So until next time, everyone, take care.